In this video, we're going to look at the differences in reporting transactions using two different inventory methods. Companies over the years have developed different ways of tracking their inventory. In the days before information technology was available, the dominant method was the periodic inventory system. Here, the inventory account was adjusted at the end of a reporting cycle. Cost of goods sold was not tracked during the period, though there were various ways of estimating the cost of goods sold. But the final accounting for inventory and cost of goods sold could not be done until the actual physical inventory was prepared. As information technology allowed for the tracking of inventory through the period, companies developed a perpetual inventory system. In the perpetual inventory system, the inventory account is continuously updated as purchases are made and sales are conducted. For each sale in the perpetual inventory system, the cost of goods sold will be matched to that sale. We're going to begin by looking at some different inventory transaction under both, first, the perpetual inventory system and the periodic inventory system. For our workshop, we're going to be using two exercises from the textbook. For the perpetual inventory system, we're going to begin with exercise 8-1. And we have a retail store, and they're using the perpetual inventory system. And we have three transactions that we are going to prepare journal entries for. In the first transaction, we're going to purchase some merchandise on account using our credit. And the merchandise is going to cost us $5,000. We're responsible for paying for shipping. So this would be FOB, shipping point. And we're going to have to pay a common carrier freight charges of $300. So merchandise is purchased on account. The freight charges will be paid in cash upon delivery. We're going to split this transaction into two, regarding first the merchandise. In the perpetual inventory system, when we purchase merchandise, we're going to increase our inventory account directly. So we're going to debit inventory, the asset, for $5,000. We're purchasing this on credit, so we are going to increase our liability by $5,000. The cost of the freight will be reflected in an increase in inventory. Inventory includes all costs that not only bring the merchandise into the business, but also all the costs that it takes to get that merchandise ready for sale. So we're going to increase inventory by $300, and since we're paying in cash, we'll decrease cash $300. In our second transaction, we've inspected some of the merchandise we previously purchased, and we found some items that did not meet our specification or were defective. And we're going to be returning merchandise that has a cost of $600 to the supplier. So this supplier will credit our account since we purchased these on credit, not by cash. We'll not be receiving cash back, but we're receiving a credit against our accounts payable. So we're going to reduce accounts payable by the $600. Since we're using the perpetual inventory system and our purchases of merchandise increased inventory, the return of the merchandise will decrease inventory by $600. In our final transaction involving inventory, we have the sale of some inventory. We're going to sell inventory for $5,200. We're going to receive cash from our customers. And this merchandise had originally cost us $2,800. In the perpetual inventory system, every time we have a sale, we're going to have the receipt of an asset, in this case, cash. We're going to have the recognition of sales revenue. In addition, we're going to recognize the cost of goods sold, and we're going to reduce down our inventory. So we're going to receive cash for $5,200. We're going to report sales, $5,200. In this problem, we're given that the cost of goods sold is $2,800, and our reduction to inventory is $2,800. In our next exercise, we're going to use the same transactions, but we're going to vary it and record these transactions using the periodic inventory system. While the transactions are the same, you'll see the accounting is going to be slightly different. This developed over time. These are generally accepted bookkeeping and accounting practices. GAAP does not dictate these. So it's possible that companies could alter this, the accounts that are used to record these transactions slightly, but the gist is going to be the same. Unlike the perpetual inventory system, when we purchase merchandise, we are not going to directly increase inventory. The inventory account will be adjusted at the end of the period. Instead, we use an interim account called purchases. So buying this merchandise on credit, so we'll increase our liability accounts payable. For the invoice amount of $5,000. For the freight, in our perpetual inventory system, we increase the inventory asset. Here, we're again going to use another different temporary account called freight in. Again, we pay for the freight in cash. Under the periodic method, when we have a return of items we purchased, we are going to recognize another temporary account called purchase returns. We debit purchases to increase it. Since we're returning some of this merchandise, we're going to credit purchase returns. Purchase returns is contra to purchases. So we're returning $600 worth of material. That's a credit to our purchase returns. The opposite side of that transaction, just like in the perpetual method, is a reduction of accounts payable. In the periodic method, cost of goods sold and the final inventory, the ending inventory, is handled in the bookkeeping process at the end of the period. For each sale that occurs during the period, the only entry we'll make is to record the actual receipt of an asset and the recognition of sales revenue. So here we're going to be selling for cash. The other side of that will be sales revenue. We do not recognize cost of goods sold or make any adjustment to inventory at the end of the period. So no entry is made for those accounts. Instead, we simply recognize the $5,200 in cash and the revenue that we recognized from that transaction. So there are differences in accounts at the end of the period. Under the periodic method, we will make adjusting journal entries that will take into account the purchases and the freight in, subtract out the returns, subtract out the cost of the merchandise sold to adjust for our ending inventory and the recognition of cost of goods sold. In the perpetual inventory method, all changes to inventory are recorded in the inventory account, either through the purchases, the freight costs, other costs to get the merchandise ready for sale, the reduced down inventory for any merchandise returns, and the reduced down inventory for each sale.